You've recorded a 29% growth in your pre-tax profits, which have now climbed to 3.7 billion. Just give us a rundown on these financials.
The main key drivers are, one, the growth in numbers of customers. The model still continues to be very attractive to those who want to open accounts for the first time. So we saw a growth of 1.3 million customers. The second one is the model has now been fitted with the low-cost delivery channels, both the mobile phone and the agency model. And consequently, the operational costs are going down significantly, reducing the cost-income ratio. As you see, so we have been able to maintain our cost-income ratio in spite of opening 2 subsidiaries this year. The last one is the resilience of the Kenyan economy. It continues to offer opportunities. The economy is still headed to grow at near 4.6%. So we could say that while the short-term microeconomic environment might not look attractive, the underlying long-term microeconomic environment is favorable. And lastly is that because of the funding model of the bank, the repricing on deposits was much lower than the pricing on the asset side, the loans, and that increased the yield on loans from 14 to 17% and enhancing the margin from 12% to 14%. So combined increase in margin and combined growth of the loan book and sustained transaction income from increasing number of customers guarantees the bank continued super performance.
Of concern, though, Dr. Mwangi, is your cost-income ratio, which is currently standing at 51% compared to the banking industry, which is 56%. Is this a concern for the bank?
Average banking industry is still at 56%. We're at 51%. And we're at 51% when we are delighting the cost of massive infrastructure development, both in our IT, like the credit calling system, the business enterprise system, the opening of 2 subsidiaries this year, Rwanda and Tanzania, and more important, taking off nearly 3 billion shillings from business to fund those investments. So you can see that all that financing cost, despite that huge investment, despite the running cost of the bank on a day-to-day cost increasing because of the near 20% inflation, the bank still maintain its cost-income ratio. So you could imagine once this stabilizes, and that's why we are consolidating to see whether we could be able to push the cost-income ratio to 45% within the next 2 years.
Moving on, Dr. Mwangi, kindly share with us your expansion strategy. Earlier this year, we saw you opening 7 new branches in Kigali, Rwanda. What is the expansion plan for this year?
At the moment, we want to consolidate the East African region. That is a region that gives us 153 million people. Together with the 11 million people from South Sudan, you're talking of 165 million people. And that population is well banked. If we were to be as big in Rwanda, Tanzania, Uganda, and Sudan the way we are in Kenya, we would be a global player. So that is what we want initially to do, so that we really become strong before we make the next leap.
We are currently operating in a high-cost environment with inflation now at 15.6%, while interest rates are currently at 18%. Will this affect the performance of the banking sector this year?
I think the corporate sector of the economy might be slowing down. But you notice that equity operates on the decorporatized sector of the economy. It operates on the households whose activities lead life maintenance, and consequently they rarely change because of they are not as prone to microeconomic shocks like the formal economy. So for equity, we are likely to see a sustained momentum. If you look at the history of equity, equity has been able to override all the economic shocks since 1997. It has never reflected in, even including the global financial crisis.
Moving on, Dr. Mwangi, and members of parliament last week voted out a bill that could have resulted in the capping of interest rates. How critical was this for Kenya's banking industry?
Anywhere interests have ever been capped, the consequences to the economy has been dismal. If they had capped interest rate to 4% plus the central bank rate, what it would have meant is that farmers who equity is reading at 10 would have been forced to pay at 22. The youth of this country that equity leads at 8 would have been forced to borrow at 22 because it's a legal requirement. But more importantly is it could have denied the market the flexibility of adjusting, because government pursuit is not necessarily the same pursuit as the private sector. So if the two pursuits are not consistent and incongruent, then you could find we could have been stalling the market from allocating resources. But more importantly is a 4% risk factor might have been too low to accommodate, for instance, consumer lending, our unsecured lending, micro lending, and what it could have been is that it could have, in one way or another, denied the majority of Kenyans a credit.